Banks have been absolutely the story of 2022 for investors, the absolute darlings. And we have seen that play out in several ways. Not only is the Bank Nifty the best performer, a whole host of banking stocks have shown mind-boggling gains. Who would believe that the 10 rupee UCO Bank stock can today trade at 37 rupees? That's UCO Bank. You have seen a similar cycle play out in a whole host of barely spoken about old private sector banks, the Karnataka Bank, the South Indian Bank, all of them have, doubled 150% or 200% gain in their stock prices in 2022. And the other trend we have seen is storied foreign brokerages, the Morgan Stanleys, the JP Morgans, who until now were only favoring the private sector banks, the new private sector banks, have started extending their coverage and their preferences to public sector banks. First, of course, State Bank was always in their list. Then you saw BOB enter. Then you saw Bank of India enter. And now some of them are talking about Punjab National Bank in their list. So clearly the list of darlings are expanding. To check out how much more, how wide will the canvas go and how much longer will they remain darlings, we have someone who knows the banking sector like the back of his hand. Sumeet Kariwala, the Executive Director-Research Analyst of Indian banks at Morgan Stanley. Sumeet, good morning. Thank you very much indeed for joining us. Let me start with a negative question. 3 days ago, State Bank of India increased its deposit rates by a good 65 basis points, and now in some brackets it's even 80 basis points higher. This comes on the back of an already 60 to 80 basis points hike in deposit rates in October. Now State Bank is paying 6.75 for a 1-2 year deposit. So do you think the best run is over for banks as the costs go up?
Good morning, Lata. Thanks for having me on the show. On margins, I think so over the next 2 quarters, we'll see quite a significant expansion despite the level that we have seen over the last quarter. Let me divide the margin expansion thesis at Indian banks into 2 parts. First is what we're going to see is the structural part, where whenever interest rates rise, banks benefit because of margins. This is because the CASA deposits won't reprice upwards. There is some normalization of competitive intensity as we come out of a slowdown. There is shift in loan mix towards high margin assets. So all of those things happen as the cycle improves. And this is the structural part that I'm talking about. I think so the margins that we have seen so far can be easily sustained by the Indian banks. We're going to see the cyclical part as well fully play out over the next 2 quarters, where the asset side of loan book, be it the repo-linked loans, MCLR-linked loans, will reprice, and they are yet to reprice over the next 2 quarters. So margins will go up by, say, 20-25 basis points over the next 2 quarters. And then in fiscal 24, we'll give away some of these margins. Look at the deposit rate hike by SBI that you spoke about. Bulk of that has happened over the last 3 months. They did the first big rate hike around Diwali, and they followed it up with another rate hike in the recent week. So the full impact of this will come 1 year down the line, and that is when you will see margins contract. But given where we are we able to sustain these margins? For sure. I wouldn't doubt that.
Okay. No, let me persist with this question a bit. You are going to see money tighten in the system. We had about a 3 lakh, I think even 6-7 lakh crore of surplus liquidity when the Reserve Bank met in September. By the time they meet in December, the surplus liquidity is below 2 lakh crore, 1.6, 1.7 lakh crore. This will mean the banking system may have to push up deposit rates a little faster because that surplus cash is not available. So, are we there for a downside surprise in interest rates? And the RBI will not raise rates much more. I did a poll and it's a 50-50 division. There are quite a few who believe 6 quarter is it. It is. And there are some who believe it can go up to 6.5. So there is not much repricing of MCLR and EBR, the external benchmark linked loans. But deposits have to catch up. So once again, my question, are we in the last leg of margin expansion?
No, that's correct, Lata. Over the next 2 quarters, we'll see margin expansion, and that's where margins will peak out. The point that I'm trying to make is that if I look at margins 1 year down the line, will we be around current levels despite the contraction that you're trying to suggest? That is something that we are comfortable about. Yes, but margins will expand and then peak out. I'm not saying that margins will peak out right now. They'll expand by 25, 30 basis points. The other thing which I want to tell you on deposit rates is that if you look at for most of 2022, banks didn't take up deposit rates.
Yeah.
They have taken deposit rates up only in the last 3-4 months.
Correct.
So the chart that I track is a deposit rate less repo. The spread actually contracted quite meaningfully, and over the last 3 months, that spread is now coming back. My view on deposit growth is that banks were sitting on a reasonably high liquidity. They wanted to utilize that. They were not early to raise deposit rates. For one to take a call on deposit rates, the time is now when we have taken up deposit rates meaningfully. And over the next 2-3 months, I would say deposit growth will pick up because the nominal interest rates have moved up, inflation is coming down, real deposit rates will move up. If I don't see deposit growth coming back over the next 6 months, that's when I'll worry about liquidity and whether banks will be able to fund growth or not.
Fair enough. Fair enough. We'll watch out for that and invite you back again. Now, the other thing that puzzles me is, why are you guys not really looking at the old private sector banks? I mean, I did see Federal on your list and RBL as well. But, you know, all of them have done well. Karnataka, Karur Vaishya, South Indian. Will we be seeing you all expand your horizons?
Alara, honestly, I can't comment on that. But what you've seen is that we have been broadening our coverage over the last 1-2 years. Just last week, we initiated on another bank. So as we find more resources and opportunities, we continue to do that. Okay. But tough to comment on what we're going to initiate or not.
No, it's just that if investors are following you all, many of them are missing the bus on some of these, old private sector banks. And a lot of the gain in the ICICIs of the world is perhaps already in the price. Why is HDFC Bank missing? I'm not asking you to comment on, buy, sell, etc. But it's not there in your list.
No, so there's a reason why HDFC Bank is not there on the list. We are currently restricted on HDFC Bank, and we can't have a view on the stock or the price target or the rating. So
okay.
Avoid that question.
Okay, I guess you're not part of the merger in some fashion. All right. Let me come to the unsecured loans. That's another red flag that some observers raise. A lot of banks are trying to improve their yield by having a larger unsecured loan book. Will that be a worry?
Unsecured loan book and the way in which there are 2-3 points I'll make over there. First is a large part of the unsecured loan book is with the large lenders in India. It's the large private banks, large state-owned banks, and large NBFCs. We track data by the bureaus on the kind of lending with respect to risk profile that we see in the unsecured loan book. And actually, if you'll see, the credit standards have been tightened over the last 4-5 years. Part of that was driven by COVID. We also track interest rates that are being offered by these banks and NBFCs in the unsecured loan book. And actually, those rates have been coming off. It just tells you that they've been taking less and less risk. So given where the penetration levels are, given the kind of underwriting large lenders are doing, I feel this is the risk over here is really manageable.
Okay. Where will you see the expansion of coverage, as you put it? Will it be more in more public sector banks? Will it be in more old private sector banks? Because I guess the new private sector banks are all covered.
Unfortunately, just can't comment.
Even that you cannot say. But will you all look at all these? Because the rising tide is lifting all boats.
Yes, so we continue to look at expanding coverage wherever we find resources and we think we can add value.
Okay.
That process, it's an ongoing process. Over the last 1 year, if you'll see Morgan Stanley India, we have initiated on a lot of new stocks. So that process kind of continues, but tough to comment on what exact we will look to add.
Okay. You know, the last banking cycle, which I covered because I was a reporter then, the turn began at the turn of the century, around 1999, 2000. And it was a great run till 2010. You know, it was a 10-year cycle. And then you started seeing the emergence of bad loans and falling loan growth. Does this cycle also go on for that long?
Yeah, we have been writing about this, and I think so. The current cycle resembles more like 2000 to 2007, which is when the state-owned banks did very well. If you look at, and back to your question on earnings, if you look at the ROAs in that cycle, we actually peaked at 1.1, 1.2 for some of these state-owned banks. Just compare this cycle to what happened in 2002. If you look at banks' balance sheet, the share of retail loans is much higher. The SLR ratios that banks are working with is much lower. You have tax rate, which is now at 25% versus 35% then. You have state-owned banks have moved to defined contribution on the pension scheme versus defined benefit then. If I think about all these factors, cyclically, state-owned banks should end up with much higher ROAs. So, which is why our view is that if you look at across line items, be it fee income, be it credit costs, be it margins, state-owned banks have significant room to surprise on earnings over the next 2-3 years. And as they do that, I don't think valuations will remain at long-term averages. Valuations will move above long-term averages. In fact, when you look at financials, the only time when valuations move above long-term averages is when growth comes back. If you're in a normal cycle with low growth, valuations will be around mean. If you are in a slowdown recession, valuations will be below mean.
Yeah.
So both earnings and valuations have upside for state-owned banks, and this is true for the entire banking sector in our view.
Okay.
Even the private banks have room to re-rate as growth comes back.
Okay.
So yes, we are quite bullish on the sector.
Okay, thank you very much, Sumeet. I was wondering, yet another banking conversation. What more new will I get? But this is a big one you have given us in terms of the comparisons, even in terms of pensions and SLRs with the previous cycle. Thank you very much for an extremely rich conversation. We have to wind up on Bazaar on the note that the mid-caps are really gone under 1.5% cut. So lots of ideas coming up for you on Chartbusters.